Hello, viewers, and welcome to our lessons. In this lesson, we are studying weighted average cost of capital, which is applicable in fundamentals of finance, financial management, as well as advanced financial management. The same is also uh, appropriate for undergraduate university students as well as students taking diploma at different levels. Now, my name is Kimanzi Williams. Other than being a public accountant, I'm also a publisher as well as an author. I have authored a variety of books relating to management, finance, taxation, economics, among other areas. So, in case you need our assistance, my numbers are 0727 This is Fatima Institute Center for CIFA Studies. We are based in Lika Town. In case of any assistance, you can get in touch via the phone number that I have provided, that is 0727 This is a revision class, and I believe that you are conversant with cost of capital, and I believe you know different sources of capital that are available for a business entity, which may include internal sources, external sources. Other sources may be long term, others may be short term. Well, the focus now here, let's focus on the weighted average cost of capital. First, what is weighted average cost of capital? Having in mind that we've said that a business may have a variety of sources of capital, among others, equity, that is ordinary shares, preference shares, and debt. As far as this discussion is concerned, rather, as far as weighted average cost of capital is concerned, we always classify costs or cost of capital into three areas, and that is equity. Equity means ordinary shares. The classification number two is preference shares, and classification number four or number three is debt. Again, so have in mind those three classifications, because when you start calculating the weighted average cost of capital, we will be taking cost of equity times weight of equity plus cost of preference shares times weight of preference shares plus cost of debt times weight of debt. Note the cost of capital, the cost of equity, we can still have cost of retained earnings. Cost of retained earnings will be similar to cost of equity, only that cost of retained earnings do not have flotation cost. Then when you look at preference shares can either be irredeemable preference shares. Irredeemable preference shares means those shares issued by the company, but the company will not purchase them back in the future. That's irredeemable preference shares. Preference shares without maturity period. Under preference shares, again, we have redeemable preference shares. To redeem means to purchase back. So redeemable preference shares are those shares issued by the company. However, the company will purchase them back in the future. Now, debts will comprise of loans, debentures, and bonds. So anytime you come across debt, think of either a loan, a debenture, or bonds. That's the first very critical part as far as weighted average cost of capital is concerned. One important thing is knowing how to calculate the cost of these capital elements. Since we have said that to calculate the weighted average cost of capital, we'll be taking cost of equity times weight of equity. It implies that you must have calculated correctly the cost of equity. Then cost of preference shares, you must have calculated correctly the cost of preference shares and the cost of debt the same. Let's elaborate that those formulas because you need them to deal with any question to do with weighted average cost of capital. Now, weighted average cost of capital simply means the cost of existing capital. The cost of existing capital. I'll still look at marginal cost of capital, that is MCC, which means cost of raising additional capital. Note that difference there, even though I'll be coming back to that in a while. That whereas weighted average cost of capital means cost of existing capital elements, the cost of the capital which is already existing. But marginal cost of capital means the cost of raising additional capital. Let's go to the formulas now. You will be required to know how to calculate cost of equity. Note that equity means ordinary shares. So when you come across ordinary shares, you are being told to calculate the cost of raising the ordinary shares. Cost of equity is given by D naught into brackets 1 plus G over P naught minus F plus G, you multiply by 100. D naught means the dividends which have been paid. Then 1 plus G, G means the growth rate, divided by P naught. P naught means market price, and F means flotation cost. So flotation cost means the cost that we incur to raise funds. To raise funds, maybe from the stock market, like insurance, what you pay to brokers, and any cost that you will incur, or consultation fees. You may consult a financial analyst or economist, and you pay that particular professional a certain amount. That amount which you pay with respect to raising shares or securities in the stock market is known as flotation cost. Basically, cost of equity will be given by the dividends paid, that is, dividends which were paid relating to ordinary shares. You multiply by 1 plus growth rate divided by market price minus flotation cost. If there was no flotation cost, then you just ignore the flotation cost because it was a 0. Then you plus growth rate, then you multiply by 100. That's the cost of equity formula. That's the formula. That's the formula for the cost of equity. The other is cost of retained earnings. You can see that there is no difference here in terms of the formula for calculating cost of retained earnings, because you can see it's the same thing here, only that we do not have flotation cost. Retained earnings cannot have flotation cost because it means that profit which was not distributed as dividends but was used by the company for the purpose of business expansion. So instead of distributing retained earnings to the shareholders, the directors may decide, instead of raising additional capital through other sources like loans, it becomes prudent to use the retained earnings which is already available instead of distributing it to the shareholders, and that is what we call retained earnings. The only cost which is incurred is the opportunity cost, which is incurred by the shareholders for not receiving the dividends. Otherwise, there is no other cost which is incurred with respect to retained earnings, because this is a source of fund which is internally available to a business entity. So note that as far as cost of equity is concerned and retained earnings, the concepts are the same. However, when we start our calculations, another difference will present itself in the sense that when using the market value or the book value, as you will see from different questions, the examiner may require you to calculate weighted average cost of capital using either market values or book values. When using book values, we consider both the cost of retained earnings and the cost of equity. In other words, the weight, for the purpose of weight, when using book values, we should consider both the retained earnings and the equity. However, when calculating WMCC using market values, we cannot consider retained earnings, because retained earning is not gotten from the market, it is gotten internally from the business entity. So cost of equity, the formula is here simply. Remember to make it a percentage. Remember, all these calculations relate to one share. They relate to one security. Cost of one security. Okay, so I believe you are okay with how to calculate cost of equity and cost of retained earnings. Away from that, we look at cost of debts. I have just mentioned that debts may either be debentures, loans, or bonds. So when you are told that a business enterprise has raised debt, you have in mind that it can either be from bonds, loans, or debentures. So the formula remains the same. A debt, what you pay, if you have a debt, what you incur as a cost is interest. If you obtain a loan, if a business enterprise obtains a loan, then you have to pay the principal amount plus the interest. And interest, since I believe at this level you have done taxation and you know that interest is an allowable expense. That is from the perspective of taxation. And thus, if it is allowable, it means that as an expense, we cannot tax interest. For that matter, or in connection with that, we have to consider the tax shield, and therefore you'll be multiplying the interest that you have calculated multiplied by 1 minus t, 1 minus tax rate. Now, before that, we should as well note that debts can either be redeemable or irredeemable. Redeemable means those debts which have been issued, but the issuer will purchase them back in the future. In other words, these are debts which have a maturity period. So cost of redeemable debentures or loans or bonds, they mean the same. They are all debts. That's important thing to note, that debts may either be bonds, loans, and debentures. So cost of debt, if it is redeemable, anytime you realize that a debt has a maturity period, it implies that the N which you have here will represent the maturity period, or the period within which such a debt should be purchased back or redeemed. Therefore, you'll be taking interest. Interest, you multiply by 1 minus t, you plus, this is par value. You know the other name for par value is the nominal value. Par value, you minus the market value, you close a bracket, multiply by 1 over n. N represents the maturity period. Then you divide by, it's just this point here. You bring it down here. But this is plus and this is minus. So just bring this one here, make this one plus. So divided by par value plus market value, and then you multiply by half, or you multiply by 0.5. So 1 over 2 or 0.5 is just part of our formula. Is our formula. That is what our formula provides. So don't use either 1 over 3 or 1 over 4 or 1 divided by another number. You are just using times 0.5 or 1 over 2. So this 1 over 2 is not originating from any mathematical calculation. I believe you have understood the formula for calculating cost of debt. The cost of debt, remember, debt, what you incur as a cost is the interest. Debt comprises of debentures, loans, and bonds. And therefore, the cost that you incur is the interest. You multiply by 1 minus t, you plus the par value minus market value times 1 over maturity time over par value plus maturity time multiplied by 1 over 2. You make it a percentage, and that will be cost of debt. Now, a debt can be redeemable, can as well be irredeemable. If it is irredeemable, then you take interest, you multiply by 1 minus t, divide by p naught, which represents the market value, and then you multiply by 100. Sometimes, if the tax rate has not been given, you just take interest for that debt, you divide it by the market value, and you multiply by 100. The last portion will be of the preference shares, and I have said that preference shares can either be irredeemable or redeemable. If you have understood how to calculate the cost of debt for redeemable debentures or redeemable debts, then the cost of redeemable preference shares becomes very simple, because in place of interest here for cost of debts, we are talking about interest, because debt, what you pay is interest. But for shares, what you pay is dividends. That is why we are talking about here dividends. We cannot multiply by 1 minus t, because a dividend is a profit appropriation, unlike interest, which is an expense. Therefore, we cannot talk about tax shield with respect to the dividends, because the person who pays tax is the person who is receiving the dividends. If you have invested in a company and that company pays you dividends, you as the recipient of that dividend, you are the one to pay tax to the government, because to you it is an income. Well, but I think if you have done taxation, uh, you must have done dividends which have withholding tax, and that is qualifying dividends and non-qualifying dividends. But if you want to learn more about qualifying dividends, non-qualifying dividends, qualifying interest and non-qualifying interests, that you can get on taxation area. We have also done taxation. We also have done taxation in our YouTube account. You can still get more from that. However, for this paper, you just need to know where where you are dealing with preference shares, this formula and this formula, they are similar to that of debts, only that you replace interest with dividends. So if you are calculating cost of irredeemable preference shares, we say that irredeemable preference shares are those shares without maturity period. Those shares without maturity period. They cannot be purchased back in the future by the issuer. Therefore, you'll be taking dividends which have been paid divided by P naught, that is a market value, minus flotation cost. If there is no flotation cost, you just less 0, then you multiply by 100. If those preference shares you have been told that they are redeemable, then it's just like cost of redeemable debts in terms of the formula, only that where there is interest, you replace interest with dividends. Remember, you cannot multiply by 1 minus t, because dividend is not an expense in a business. Dividend to a business is profit appropriation going to the investor, and therefore it is the recipient, the investor, who is supposed to pay tax to the government relating to those dividends received, depending on whether the dividends in question are qualifying or non-qualifying dividends. So dividends, there's D naught plus par value minus market value, you multiply by 1 over maturity period divided by par value plus market value, then you multiply by 1 over 2, then you times 100. Those formulas, I once again repeat that if you want to be very perfect with respect to weighted average cost of capital, you should be very familiar with the calculation of the cost elements, of the capital, the cost of capital elements, that is how to calculate cost of equity, cost of retained earnings, cost of redeemable debts, and we have said debts comprises of bonds, loans, and debentures. Then cost of irredeemable debts, that is either debentures, loans, or bonds. Then cost of irredeemable preference shares and cost of redeemable preference shares. So note here, once you have familiarized yourself with the formulas that I have explained, and I believe I have explained very well, so you cannot claim not to have understood. However, if you have not understood, my numbers are 0727 8710 93. Just call for clarification. Alternatively, you can purchase my textbooks, which I have published to familiarize yourself with these concepts, which we have comprehensively and in details explained in very elaborated manner in our books, both study text and revision materials, from ATD to CPA to CIFA, among others. Well, once you have calculated all these costs now, you can see our formula that we use to calculate WMCC, weighted average cost of capital. We've said that weighted average cost of capital means the cost of existing capital, the cost of existing capital, not the cost of raising additional capital. The cost of raising additional capital is known as marginal cost of capital, MCC. Now here, the reason why I have insisted that you should familiarize yourself with the calculation of the cost of these capital elements is because you find that here you'll be taking KE, that is cost of equity. You still be taking KD, cost of debt, which can either be irredeemable debt or redeemable debt, which can be a debenture, loans, or bonds. And then cost of preference shares. Preference shares can either be redeemable or irredeemable. So you calculate the cost, this cost of preference shares, the cost of debts, the cost of equity. These formulas here will help you now to get that. And then you are multiplying by weight of equity, weight of debt, and weight of preference shares. Now, I'll show you the other part to do with the weights, but weights are more easier. Another important thing that we should note before we continue is that you can be told to calculate WMCC using market values or using the book values. If you have been told using book values, you are being told to consider the values as per the statement of financial position or what is in the balance sheet. That's the book value. You just need to go to the statement of financial position or the balance sheet, as some of you refer to the same, and you look at the information provided for them. But if you are told using market values, then you have to consider the number of shares that you have as per the books, but you multiply by the price prevailing in the market. That will only, the question of whether you are using book value or market value will only affect the weight. The cost will not change whether you are using market value or book value. The cost of equity, the cost of debt, the cost of preference shares, everything else here will remain the same, but the weight is the one to change, the weights. Now you can better understand that one in an example, and that is what I'm going to take you through. Let's have a question here. We are told Delights Limited capital structure is at that 1st December 2014 was as follows. These figures are in millions. We have ordinary shares at shilling 0.50 per value, 12,000. Reserves. We say the other name for reserves is retained earnings. A reserve or retained earning means the profit which has not been distributed as dividends to the shareholders. I've said it is a cost-free source of fund to a business enterprise. The only cost that you incur is the opportunity cost, which is incurred by the shareholders for not receiving the dividends. So reserves, we have 4,000. Then we have 9% preference shares at shillings 1 per value, 6,000. Then 14% debentures. This is our capital structure. And capital structure, we can have ordinary shares as a source of finance. We can have retained earnings. We can have preference shares, and we can have debentures. Now, these debentures, collectively, debentures, loans, and bonds are referred to as debt, the debt collectively. So these debts can either be redeemable or irredeemable. Preference shares can either be redeemable or irredeemable. And that is it. This is the capital structure that we have for that particular company. Additional information. The ordinary shares are quoted at shillings 0.80. So when you are told the ordinary shares are quoted, this means they are selling at 0.80 in the market. This is what we call the P note in our formula. They are quoted at shilling 0.8. That's they are selling at 0.80. If you go to the stock market, you purchase them at 0.80. But if you go to the books of accounts now, you find the par value is different. They are giving us 0.50. This is the par value as per the books. But you go to the market, you are getting the same at 0.80. Because the market prices do fluctuate, they change. The market prices are not the same throughout. The share prices will change from day to day, month to month, year to year. The prices prevailing today in the market will be different tomorrow and in the future. But the par value remains the same. The par value remains the same. You cannot change the par value of shares of a company without altering the constitutive documents, that is the memorandum of association. The memorandum of association, I think you have done company law and you understand what is involved in changing some of these things which are found in the constitutive documents. So my explanation here is that whereas 0.50 is the book value, the par value or the nominal value, which remains constant, 0.80 is the market price of that particular ordinary share in the market. Number two, the next ordinary dividends are estimated at shillings 0.04, growing thereafter at 12% in perpetuity. Now we have said D note. The examiner has to give you the D note, the dividends, and the growth rate, because our formula for cost of equity is D naught into brackets 1 plus G over P naught minus F, then plus G times 100. So here we have been given D naught is 0.04, 12% is a growth rate. There is no flotation cost, therefore in our calculation we will not factor in flotation. Number three, the preference shares are quoted at shilling 0.72, while debentures are quoted at par. Now, preference shares in the market, they are selling at 0.72. When you go to the market, you get them at shillings 0.72. However, their par value, you go to the books, you get them at 1 shilling. Debentures are quoted at par. That means In the market, they are selling at the same figure, which is quoted in the books. They are selling at par. Then corporate tax rate is 30%. Required weighted average cost of capital. Let's focus now on our calculation. I started by saying that for you to be very conversant and comfortable with the weighted average cost of capital, the first step is to know how to calculate each capital element. We said that cost of equity, because now we have equity here, ordinary shares, the other name is equity. So what is the cost? Because weighted average cost of capital, WMCC, means cost of existing capital elements, not the cost of raising additional. So what is existing already is the cost of this, what we already have. What is the cost? What did it cost us to have these ordinary shares? The formula is here, D naught, which represents dividends. We have been told that the next ordinary dividends are estimated at shilling 0.04. So 0.04 is our D naught here. That's what you can see is here, 0.04. Into brackets, 1 plus G, growth rate, you are told it will be growing thereafter at 12%. So you are plusing 12%, you make it decimal, 0.12, over P naught. They are selling at how much in the market? They are selling at 0.80. Is there flotation cost? We have not been given flotation cost, and therefore we assume that there was no flotation cost. Then you plus G, the growth rate. Growth rate was 12%, so 0.12. So you work out this. If you work out this, just understand this formula here, and now you substitute. Work out this, then you multiply by 100. The cost of equity will be 17.6%. Note the 17.6 because it will be used here. Here, 17.6, when we start calculating WMCC, as the cost of equity, 17.6, this one here, will be used there. Now we have done the cost of equity. We go to cost of preferred shares. I want you to note that because we are told weighted average cost of capital using the book values. Okay, let's have the next one. Cost of preferred shares. Cost of preferred shares. Now, these preferred shares are irredeemable because we have not been given maturity time. No maturity period has been provided. If there was maturity period provided, then we could have treated that as redeemable. But you've been told that the preferred shares are quoted at shilling 0.72. So 0.72 is the P naught. They are selling at P naught. Now let me remind you, remember here with the preferred shares, 9% preferred shares at shillings 1 per value. What's the implication there? They are not redeemable. They are irredeemable. So if they are irredeemable, then your formula should be dividends over market rate minus flotation cost minus 100. If you are told that these preferred shares will be purchased back on a certain period, then you could have used the other formula. So dividends, how much dividends were paid? Note here now, when you are given a certain percentage here and the per value, because in the weighted average cost of capital, we are interested with cost of one share. Only one. We are dealing with cost of one share. Therefore, if the per value is 1 shilling and we are paying preference shares at 9%, it means that each share you pay dividends of 9% of 1. Dividends are based on par value. I should repeat that one. Dividends are paid based on par value or the nominal value, not the market value. We can't pay dividends based on the market value. We pay dividends based on the par value because par value is constant. The par value does not change. If we were to pay dividends based on the market value, then there is a problem with predictability. We should pay dividends based on the par value, something that we can predict. We should be able to predict the dividends that we pay within a certain period. Now, that's why here you've said dividends now to be paid is 9% of 1. You get 0.09. Then KP now, the cost of preference shares, we have said these are irredeemable. We'll be taking dividends 0.09, this one here, divided by P0, the market value. You're being told the preference shares are quoted at shillings 0.72. So we divide by 0.72. And our cost of preference shares will be 12.5%. So 12.5% is the KP, the cost of preference shares. And when you come to our calculations now, that figure will be here. KP, you multiply by weight of preference shares. We do the weights in a while, but not the 12.5. The 12.5% will be here. You have said that KE 17.6% will be here. 17.6% will be here. KP 12.5 will be here. Then the last part is cost of debentures, the KD. Now, what kind of debentures are these? We have said that debenture is a debt. Collectively, debentures, loans, and bonds are known as debts. So, we've been told something here that the preference shares are quoted at shilling 0.72, while debentures are quoted at par. Let's go on with our calculation. They will cost what figure? They will cost what? Now note that these debentures are irredeemable. These debentures are irredeemable. They do not have maturity period. If you had been told that these debentures have a maturity period, then you could have used this formula here. If you had been told that these debentures have a maturity period, you could have used this formula. But there is no maturity period, you just take that one. Interest, you multiply by 1 minus t over P0. Now here, I did not multiply by 1 minus t. I just ignored the tax shield, but it is advisable to multiply by 1 minus t. I forgot in my workings, but that's not a big issue. The answer that you get here, 1120, you multiply by 0.7 because it is 1 minus t. Okay, but we have the solution here. Assuming that there was no tax shield, cost of debt is interest. You multiply by 1 minus t over P0, and P0 represents the market. You are being told that debentures are quoted at par, meaning the par value in the books, the par value of the debentures in the books is the same value at which they are selling at in the stock market. So they are selling at 8,000. So cost of debt is 14%. See where the 14% is coming from. Debentures or debts, we've said that what you pay is interest. What you pay is interest, not dividends. So 14% of 8,000, 14% 14% of 8,000, you get 1120. I've said that you can multiply this one by 1 minus t. That is 1 minus 0.3. That's okay. No problem. But I have ignored the tax shield. KD now is interest 1120 over P naught. They are selling at how much? 8,000. Since you have been told that debentures are quoted at par, in the market they are selling at 8,000, times 100, you get 14%. And that 14% is your KD, the cost of debt. That is the KD, the cost of debt. So we have gone for this formula here, cost of debt. So KD, very important, will be here, KD. So you have our KE, cost of equity, we got 17.6%. Then KD, we have just gotten 14, we just gotten 14%. And then KP, we got 12.5%. The other part is just the weights now. Let's move on. So you have done the cost of each capital element. You've done the cost of each capital element. Now, let's use book values. I've said that now, when using book values and you have been given ordinary shares and reserves, you combine both. Reserve should be part of the weights. When we are calculating the weights, the reserves or the retained earnings, and this is what I'm talking about here. These reserves, I want to know what is my weight, the proportion that the ordinary shares form. If you sum up these figures, what proportion does this one form? All right. So if you are using book values, you have to consider the reserve. Reserves are also known as retained earnings. Why are we considering reserves or retained earnings when using the book values? Because book values means the figures as they are in the statement of financial position. But if we are told to use the market values, we cannot consider reserves because reserves are not raised from the market. Reserve is the same as retained earnings. Therefore, for the purpose of calculating the weights, we cannot consider retained earnings since they are not raised from the market. However, since we are using book values, we should use the reserves because they are still in the book. So you combine, we are looking for the weights now. You take now reserves to be part of ordinary shares. You combine them together, so you are taking these ordinary shares, you plus reserves, and you get 16,000. Now 16,000 now is the equity. So you say your equity is 16,000. We have considered this reserves of 4,000 because we are using book values. Then preference shares, they are 6,000. Preference shares, we have 6,000. The other proportion or the other is debentures. Debentures is 8,000. So we've considered summation of all these numbers because we are using book values. Now remember, you have combined reserves with ordinary shares so that you may ask yourself, what is the weight? All right. Once we have that, our totals now is 30,000. How do we calculate WMCC? WMCC, I've said, is given by cost of equity times weight of equity plus cost of debt times weight of debt plus cost of preference shares times cost of preference shares times weight of preference shares. Remember now the costs which we have calculated. Let me remind you, there are three. We calculated three costs. 17.6 for equity. So you take 17.6 times weight. Okay, note this now. Cost of equity, 17.6. Cost of preference shares, 12.5, and cost of debt 14. Those are the three cost elements that you'll be using in your formula here. So when you come here, you take cost of equity, you got 17.6 times weight. What is the weight? Weight of equity. Now weight is what I'm showing you now. I have shown you the how to calculate cost of equity, cost of retained earnings, cost of debts, whether they are redeemable or irredeemable, cost of preference shares, whether they are redeemable or irredeemable. Thus, you'll be taking cost of equity, which you have calculated as 17.6, you times weight, the weight of equity. Because you are using book values and the reserves is part of the book, is in the books, we summed these two numbers to get 16,000. So 16 over 30, the totals. That is what we mean by weight. Weight is quite simple. Weights are quite simple. The only difficult part is calculating the cost. The cost now. Since weight, you are saying weight, you pick one element, one capital element divided by the total. Remember here, we have taken reserves plus ordinary shares. Why? Because we are saying using book values. We are using book values. If you are using book values, we have to consider the reserves. If you are using market values, that may not be the case. So 17.6 times 16 over 30. 16 is this one. Plus KD weight D. KD, cost of debt, we got 14. You multiply by debt is 8,000. 8,000 over that 1,000. 8,000 over that 1,000. You plus preference shares, we got 12.5. Preference shares, cost of preference shares, we got 12.5. So we are getting 12.5, you multiply by 6. Preference shares, 6,000. 6,000 over the total. WMCC, you sum up now. This one will be 9.4, this part will be 3.7, and this part will be 2.5. So WMCC is 15.6. So 15.6 means that is weighted average cost of capital. WMCC means the weighted average cost of capital. So meaning if you take those three sources of capital, in average, the company has spent 15.6% to acquire that capital. So that is a WMCC using book values. Let's try the same using market values. So market values now means these shares are selling at how much in the market. If you were to go to the market, you will get these shares at how much. I have said that the weight will not change. Not the weight. The cost will not change. The only thing that will change is the weight. So cost of equity will be 17.6, just as in the previous year, 17.6. Cost of debt, we got 14. It will not change. These don't change. And cost of preference shares, 12.5. 12.5 preference shares. The only thing that will change is the weight. Since ordinary shares are selling at 0.8 in the market, to get the market price for the total ordinary shares, you multiply the number of ordinary shares that you have times the price in the market. Now, in the market, they are selling at how much? You are told the ordinary shares are quoted at shillings 0.8. The ordinary shares are quoted at shillings 0.8. So in the market, they are selling at 0.8. If we are using book values, we have used just these figures as they appear here. So what you need to ask yourself is 0.8 times how many shares? Since the total value here is 12,000, you divide by 0.5, it will give you the number of shares. How many shares are here? If we have total of 12,000 and the par value is 0.4, how many shares are these? 12,000 divided by 0.5 is 6,000. So we have 6,000 shares. 6,000 shares. And if we go to the market, if we go to, is that correct? Not, it should be 24,000. 12,000 divided by 0.5 should be 24,000. 24,000. So we have that means 24 million. So how much now? If we have 24 million ordinary shares, and if you go to the market, they are going at 0.8. You take 24 million times 0.8. Right? So that is what you can see we did here. Ordinary shares, we took 12 million, the total value, divided by par value, and we get the number of shares. We have 24 million shares. Then preference shares, the total values with preference shares is 6 million. The par value is 1. So how many shares do we have? This company has 6 million shares. Because 6 million divided by 1 is 6 million. So 6 million shares is what we have. 6 million is what we have. Now debentures, we have no problem with the debentures because we have been told that debentures, this point here, debentures are quoted at par. So if they are selling it, if the book value is 8,000 or 8 million, then again in the market it is the same figure. So you have no issue with that. So debentures will remain at 8 million because they are quoted at par. Now, what is the market price now for ordinary shares? Because we have 24 million shares in number, and in the market they are selling at 0.8. You take 24 million times 0.8, you get this figure here. Preference shares, they are 6 million, but they are selling at how much in the market? If you go to the market, you get them at 0.72. 0.72. Therefore, if you go to the market to purchase 6 million preference shares at 0.72, you get this particular number here. Debentures, they remain the same. So sum up these three, and you have total market value of 3,152,000. So you've said this is the area you require for the purpose of weights. Okay, now we are there. Now because we are using market values, we have done using book values. It depends with what the examiner is asking you. The examiner may tell you using book values or using market values. So if you are using book values, your answer will be 15.6%. If you are using market values, then you have to consider the weights now. How many shares do you have times they are selling at how much in the market? Then you sum up that. Costs will remain the same. So cost of equity, we got 17.6 times weight, 19.2 here. Important thing to note here, when you are using the market values, you don't consider the reserve or the retained earnings. You see what we have done with the previous, when using book values, we took ordinary shares plus reserve. Because book values means the values that we have in the statement of financial position, the values that we have in our books. But because reserves, which means retained earnings, this amount was raised internally, this amount was generated internally by the company, it appears in our books and therefore should form part of the computation of the weights. However, if we are using market values, the reserves were not gotten from the market. this is an internally generated source of capital to the business. Therefore, it was not raised from the market. That is where you can see here the market price for ordinary shares. We have only considered this 24 million here, which we got by dividing the total figures here, 12 million divided by 0.5. Reserves, we just ignore that. We don't consider reserves when calculating the WMCC using the market values. So we have this figure here, you have this figure here, you have done that, so we have here cost of equity 17.6 times weight 19.2 over that 1.5 plus KD. KD, we got cost of debt, we had calculated that. We got 14. You multiply by debt is here 8 million over total, that one, plus cost of preference shares. Preference shares, we had gotten 12.5. Preference shares, we had gotten 12.5 times weight, preference shares 4.32 over the total, that 1.5. So you work out this part now. So WMCC will be 10.72 plus 3.55 plus 1.71. And our WMCC using our market values will be 15.98%. 15.98%. Note here, when calculating the weights using the book values, retained earnings, also known as reserves, are used as part of equity. That is when using book values. However, when computing weights using the market values, the retained earnings or reserves must not be included. So we have done that. So you should have the knowledge about how to calculate, the weighted average cost of capital using either market values or using the book values. I've said that WMCC, or the weighted average cost of capital, is the cost of existing capital. If you are calculating cost of raising additional capital, then in that case you will talk of marginal cost of capital. The next lesson we will take a question on MCC, marginal cost of capital. So that is what about that. That is the end of our discussion about weighted average cost of capital. So understand how to calculate cost of each capital element, that is cost of equity. Cost of retained earnings is not necessary. Cost of debt, you have said debts can either be redeemable or irredeemable. This is a formula for redeemable preference shares. This is for irredeemable. Then preference shares can be redeemable or irredeemable. Then the formula for WMCC is here. Make sure you calculate your KE correctly, KD correctly, and KP correctly. So after discussing that, we did this question together, and I think you have gotten those concepts. So can we leave it at that? I believe we should leave it at that for now, so that you may go to sleep. It is almost midnight, so you can stop at that. My name is Kimanzi Williams. I'm a publisher as well as a public accountant. So in case you need books which we have written more about finance, feel free to call my number 0727 87 10 93. 0727 87 10 93. You can get ATD books, that is Accounting Technician Diploma, where this chapter is tested and the fundamentals of finance. For CPA, you find it in intermediate level, that is financial management. In advanced level of CPA, you have it at the advanced level, advanced financial management. For CIFA, that is certified investments and financial analysts, you have this chapter under the foundations level, that is introduction to finance and investments. Introduction to finance and investments, that is for those who are taking certified investments and financial analysis, foundation level. For those who are taking degrees and diplomas, it is available, or it is appropriate, this chapter is appropriate at different levels, the first years and those who are at second years, and so forth. So let's leave it at that. I think you have captured what is necessary. Kindly subscribe to our YouTube channel so that you may continue to get these very helpful discussions for those who are taking finance, accounts, among other professions. Thank you for watching. Let's meet again tomorrow as we take marginal cost of capital.